Hi, here at Team Velivit. We believe every question has an answer, every problem has a solution, and everything is possible. Please subscribe to our channel, hit the like button, and share these videos with everyone you know. By the way, we saved the best tip at the end of the video. Now for today's topic. Credit analysis is a critical component of financial management. Whether you're an individual applying for a loan, a business seeking financing, or a financial institution evaluating the creditworthiness of potential borrowers. Two key frameworks often used in this context are the 8C's and the 5P's of credit. This guide will provide a comprehensive understanding of these frameworks, their importance, and how they can be applied in real-world scenarios. Part 1. The 8C's of credit. The 8C's of credit are a set of criteria used by lenders to assess the creditworthiness of a borrower. These criteria help in evaluating the risk involved in extending credit and the likelihood of repayment. Each C represents a different aspect of the borrower's financial situation and character. First is character. Character refers to the borrower's reputation, integrity, and track record of financial responsibility. It is a qualitative measure of how trustworthy the borrower is in repaying loans. Key indicators include credit history, such as past behavior in managing credit and meeting financial obligations. References like feedback from past lenders, employers, or other professional connections, and stability, like longevity in employment, residence, and relationships. Second is capacity. Capacity measures the borrower's ability to repay the loan based on their current income and existing debt obligations. It's a critical factor in determining whether the borrower can afford to take on additional debt. Key indicators include debt-to-income ratio, which is the ratio of monthly debt payments to monthly gross income, cash flow, which is the borrower's ability to generate sufficient cash to cover debt payments, and employment status, such as the stability and reliability of income sources. Third is capital. Capital refers to the borrower's net worth or the difference between their assets and liabilities. It represents the borrower's financial strength and ability to withstand financial difficulties. Key indicators include assets, such as savings, investments, property, and other valuable resources. Equity, like ownership interests in property or business, and financial reserves, which includes emergency funds or liquid assets available to cover unexpected expenses. Fourth is collateral. Collateral is an asset pledged by the borrower to secure the loan. If the borrower defaults, the lender can seize the collateral to recover the loan amount. Key indicators include type of collateral, such as real estate, vehicles, investments, or other valuable assets, value of collateral, which is the market value of the asset compared to the loan amount, and ownership, like clear and undisputed ownership of the collateral by the borrower. Fifth is conditions. Conditions refer to the external factors that might affect the borrower's ability to repay the loan. This includes economic conditions, industry trends, and the regulatory environment. Key indicators include the economic environment, like interest rates, inflation, and overall economic stability. Industry conditions, such as the borrower's industry health and its future outlook. And loan terms, including specific terms of the loan, such as interest rates and the repayment schedule. Sixth is compliance. Compliance involves the borrower's adherence to laws, regulations, and standards relevant to the loan. It ensures that the borrower is operating within legal and ethical boundaries. Key indicators include regulatory compliance, which is adherence to financial and legal regulations, tax compliance like timely and accurate payment of taxes, and ethical standards, including the borrower's commitment to ethical business practices. Seventh is contingency. Contingency refers to the borrower's preparedness for unexpected events that could impact their ability to repay the loan. It assesses the borrower's risk management strategies. Key indicators include emergency plans, such as strategies in place for dealing with unforeseen financial challenges. Insurance, which includes adequate insurance coverage to mitigate potential risks. And backup income, like secondary income sources or additional financial support. 8 is confidence. Confidence is the lender's perception of the borrower's overall creditworthiness, often influenced by subjective factors. It's the lender's belief in the borrower's ability and intention to repay the loan. Key indicators include lender-borrower relationship, which is the history and quality of the relationship between the borrower and lender, reputation, which is the borrower's standing in the community and industry, and intuition, which is the lender's gut feeling or instinct about the borrower. Part 2. The 5 P's of credit. The 5P's of credit provide a different but complementary framework for assessing credit risk. These criteria focus more on the borrower's profile and the context of the loan. First is person. Similar to the character C, this refers to the borrower's personal qualities, including their honesty, reliability, and financial history. Key indicators include credit score, which is a numerical representation of the borrower's creditworthiness, background checks like criminal history, past bankruptcies, or other red flags, and professional reputation, which is the borrower's standing in their professional community. Second is payment. Payment refers to the borrower's historical ability to meet financial obligations, particularly in terms of timeliness and consistency. Key indicators include payment history, which is the record of timely payments on previous loans, default rates, which is the incidence of missed or late payments, and current obligations such as existing debts and their repayment status. Third is purpose. Purpose examines the reason for which the loan is being requested. Understanding the purpose helps the lender assess the risk associated with the loan. Key indicators include loan application details, including specifics about how the loan will be used, business plans for business loans, the clarity and feasibility of the business plan, and project viability, which includes the likelihood of success of the project for which the loan is being taken. Fourth is protection, which is similar to collateral. Protection refers to the safeguards a lender has in place in case the borrower defaults. It often involves collateral but can also include guarantees or other forms of security. Key indicators include collateral value, which encompasses the adequacy of collateral in covering the loan amount, guarantees, such as personal or third-party guarantees, and legal protections, like lien rights or other legal claims the lender can enforce. Lastly is perspective, which is similar to conditions. Perspective involves the broader context of the loan, including economic and market conditions that might affect the borrower's ability to repay. Key indicators include market trends, such as current trends in the borrower's industry or market, economic outlook, which includes general economic conditions, like recession or growth periods, and regulatory changes, such as potential changes in laws or regulations that could impact the borrower's business. Conclusion. Understanding the 8C's and 5P's of credit provides a comprehensive framework for assessing creditworthiness. Whether you are a lender, a borrower, or someone interested in financial management, mastering these concepts can help you make informed decisions and mitigate risks. By analyzing the borrower's character, capacity, capital, collateral, conditions, compliance, contingency, and confidence, alongside considering their person, payment history, purpose, protection, and perspective, one can achieve a well-rounded evaluation. This balanced approach is essential for successful credit management and financial decision-making. For the lenders, applying these frameworks allows for a structured and thorough assessment of potential borrowers, reducing the risk of defaults. For the borrowers, understanding these criteria can help you improve your credit profile and better prepare for loan applications. And for the financial advisors, these tools are invaluable in guiding clients through the credit process, ensuring they understand the factors that will influence their credit outcomes. By internalizing and applying the 8C's and 5P's of credit, all parties involved can foster a more transparent, trustworthy, and effective credit environment. As always, here at Team Believe It, we believe every question has an answer, every problem has a solution, and everything is possible. Please subscribe to our channel, hit the like button, and share these videos with everyone you know. Thank you.